I'm Stephen Grocott, Managing Director and CEO of Queensland Pacific Metals. QPM is developing the TEC project, that's the Townsville Energy Chemicals Hub project, to process a nickel laterite ore directly through to the high purity nickel and cobalt sulfate, which goes directly into the lithium-ion battery supply chain.
Right, nickel. It's had a good. Well, it's kind of interesting year last year, but in terms of pricing, it seems to be on the up. But you're doing this in Oz. When did this project start, and how did you pick it up?
The project started, well, the company started about 4 years ago. The project in itself really started about 2.5 years ago. We've had a long-standing relationship with nickel suppliers, miners in New Caledonia, and we plan to import ore from them into the port of Townsville and process them at a very nice location just south of the port of Townsville.
Right. So you're taking the risk, the mining risk, out of this, and being the kind of processor, the kind of downstream component. Why have you chosen to do this? And how did you manage to pick up these supply in the first place?
Well, the now shut down Queensland nickel refinery had imported ore from New Caledonia for a couple of decades, and one of our founding directors had the relationship with those ore suppliers. So it was a ready relationship there. And those miners have been in operations for many decades, so quite mature. And as you said, low supply risk.
Right. But so what happened to the last setup? You picked this up because they weren't bust, presumably? I mean, what happened?
Yeah, Queensland nickel refinery shut down in 2016. It's a relatively old technology, high cost producer, and it just wasn't economical in that climate.
Right, but so what's going to be new with you?
We use a completely different process, something that's called the direct nickel process. The direct nickel process dissolves virtually all of the ore, leaving a small amount of an inert residue, which can be used as an engineered landfill. And it processes all of the nickel and cobalt, obviously, into the battery grade materials. But it also, the iron ends up as high purity hematite, the magnesium as a high purity magnesia. So we have a bunch of byproducts as well, and very low residue.
Right, but is this a new technology? Is this intellectual property, reside with you?
Relatively new. It was developed about 15 years ago, got close to commercialization, but 15 years ago, the only market for nickel was really stainless steel. And so that process was competing with low-cost nickel pig iron, which even today is still the cheapest way of getting nickel into stainless steel. But to get nickel into high-purity battery-grade materials, nickel pig iron doesn't cut it, nor does ferronickel or nickel matte. You can do it with a chemistry set, but it's expensive and it's really, really dirty. We go direct plug and play into the battery industry. So 15 years ago, that battery industry didn't exist. Now it does. So the time is right.
Right, and is that because what you're going to get you're going to get a higher priced product for in terms of what you're selling into the EV sector versus obviously stainless steel, where they can pick up some fairly dirty nickel and still make it work.
That's correct. You can go from nickel pig iron or matte or ferronickel or even class 1 nickel into battery grade nickel and cobalt sulfate, but it's an additional processing step. So we bypass all of that. We go directly into the nickel and cobalt sulfate. So to get a bit technical, all those other processes go up the thermodynamic hill and then have to come back down again. We just cut straight across the valley. So it's a perfect process for battery grade materials.
Right, but so are we saying it's a technology which is yet to be proven commercially, or because it sounds a bit conceptual at the moment?
So the process is yet to be fully commercialized, but the component steps in there, the leaching is totally conventional, the ore preparation is conventional, the nitric acid recycling is exactly what is used in the nitric acid industry. The nitric acid regeneration step, the company we're dealing with has built 77 of these plants. We will be the 78th. So the Lego blocks, none of them are particularly novel. Putting it all together has some novelty, and yeah, there's always some risk with that, but it's not a science experiment. It's just assembly of commercial blocks.
Okay. So individually, the moving parts are all tried and tested. You're just putting it together in a different format for what you want to try and do. Okay, get it. We need to sort of talk about what's the big idea, right? Obviously, we kind of get what you're trying to build and the market you're trying to feed into, but how do you do that? I mean, how do you fund the build, or is there not much more kind of capex required, and this is just an opex exercise you're picking up on, an existing infrastructure? I mean, how stressful is this going to be in terms of capital requirements?
No, absolutely no stress at all, because Duane will answer the question.
Hello, Duane.
Look, the biggest the biggest challenge, or one of the bigger challenges we face, is funding the capital cost of the project. And that will be a traditional project finance for between 50 and 60% of the capital, with equity the remaining amount. There is very strong support from the government-led debt agencies, both in Australia and with our equipment supplier countries and our offtake countries, who are very keen to see the supply chain of critical minerals or battery minerals from tier 1 jurisdiction to other tier 1 jurisdictions. And that is something which will certainly assist in the overall funding of the project and bring it through to completion over the next 2 to 3 years.
Okay, so you've got the feed, you've got the site, you've got an infrastructure in place, and you're talking about the kind of capital requirements to kind of get things moving. Before you can have meaningful conversations with the capital providers, you're going to need to show a kind of route to market, a route to revenue, as it were. So here are the end buyers for whichever version of these products that you spit out.
We're in an unusually positive situation. We have 100% of our production already tied up in binding offtake agreements with 3 absolutely tier 1 customers. So LG Energy Solution, world's second biggest battery producer; POSCO, one of Korea's biggest companies; and General Motors. And so between the 3 of those, they've invested in us, so they've got skin in the game. They're about 16% owners, and 100% of the offtake for our plant is tied up with them. In fact, General Motors have even requested and locked in 100% of the offtake for a second plant should we build that.
That's interesting. So they've got an option there, or is that?
No, it's a binding offtake, and they've invested $69 million US in us.
No, I was referring to the second plant. Should that come along?
Yes. If the second plant is built, they've got the option. Yes.
Okay, interesting. A lot of money. I was talking to someone this morning about I think Ford are allocating $500 million towards their securing their metals supply going forward. A lot of money with their OEMs for sure. So what are the size of those contracts? Because it seems quite simple. The way you're laying it out seems quite simple, in the sense that you've got a buyer. Actually, tell us about some of the terms that's been secured on. Is that at market, or are they getting a discount?
Yeah, it's tied to LME, and in the case of nickel sulfate, to a nickel sulfate premium as well.
Okay, so you know where you're going to end up. So you need to kind of put this thing together, a Lego build here. So what's the time frame we're talking about?
So we're completing some engineering work leading to final investment decision in the second half of this year. Start some early works construction later this year. First production late 2025.
Okay, so this simply comes down to the cost of capital then, depending on where you get your money. You've got end buyers, so you can use that with any discussions from financiers. There's a security there, certainly with tier 1 balance sheets like they have. So this is a cost of capital exercise for you, and then obviously FID, you've actually got to deliver the thing. So where are you? What type of money are you looking for? You mentioned a few sort of subsidies and funds locally from local and federal government. So when does that decision actually happen?
Yeah, well, we're in the capital cost of the project is approximately 2 billion Australian dollars, as per our advanced feasibility study released last year. In terms of the project finance, the negotiations are now underway with the banking syndicate and the likes of Export Finance Australia, the North Australian Infrastructure Facility, and Export Development of Canada, are 3 key government agencies who have given us support for the debt component. There will be other providers, both ECAs as well as commercial banks, but they are 3 cornerstone investors for us. And on the equity, I'll call it the equity plug, which is the difference between the two. There is very keen interest from a combination of institutional investors who can see the benefit in the EV chain and the benefit of the EV growth, but also our sustainability credentials, which Stephen will take you through, are critical in terms of the attraction from sustainable funds, from green funds around the world, particularly, who are keen to invest in assets which are reducing the planet's carbon footprint.
Okay, so but it's a big ask, right? So for some people that might be, you know, breathtaking, and think, well, okay, I want this company that's going to move forward in a few of these conversations where I kind of dive in here. But one of the the security questions which the debt guys are going to be asking is, okay, apart from local government maybe getting involved and helping with the debt element, is tying down the supply, the feed, as it were. So how tight is that, the contractual side, with the you know, with the provider of whatever's going into your plant?
So we have 100% of our ore tied up in contracts already with two of the largest miners. So SLN, who are majority owned by Eramet, and SMT, who have been operating in New Caledonia for about 40 or 50 years. So that ore supply is tied up in binding agreements with them, and there are huge resources. And importantly for New Caledonia, they are a big exporter of nickel laterite ore, but it's the saprolite, the bottom half of the ore body. They have to mine through the top half of the ore body to get to that. That top half of the ore body has the same, it's got the nickel equivalent grade, the same as the bottom half, but it's not easily processed. It can really only be processed currently in high pressure acid leach plants. They are highly problematic and have a big footprint. In French, excuse my lousy accent here, but it's called ore fatal, fatal ore. And we can process the whole profile, but since you've got a problem with this top half, we'll take that. So a very secure supply.
Okay, so the HPAL is expensive, but no more expensive than, you know, your $2 billion capex requirement. It does have some issues around the green element, for sure. So you're saying what you can take both types or multiple types of ore and process it through your technology. Is that what you're saying?
Yeah, that's correct. We use nitric acid leaching. Nitric acid is the most aggressive and best leaching agent you can use for acid leaching of ore. The only problem with it is people haven't used it because it's relatively expensive, but the direct nickel process recycles about 99% of that ore, so it makes the acid cost is not even in our top 5 costs. It's a minor cost for us.
Right, interesting. Okay, and how important is this kind of green? Like every company's last couple of years is about ESG and net zero carbon and, you know, carbon capture and carbon credit. Yeah, it's become a sort of de facto language. And I was just reading a report before you came on, we're talking, well, actually, in terms of on the funds side of things, the fees for some of these funds is 3 times the cost of regular funds because of the green element. So there's some positivity to it when it's been done properly, and there's some negativity to it because it's just quite frankly, people jumping on the bandwagon. Your credentials are going to be super important because you're talking, your whole presentation is about the EV thematic. You're dealing with battery metal here, and you're feeding into organizations, OEMs, who are going to be, you know, measured on it and judged on it in terms of the products that they output. So for you, how do you deliver on your side of that relationship?
I'm so glad you asked this because most green claims are greenwash and green rubbish. We have a life cycle analysis, an independently verified life cycle analysis compliant with the 2 ISO standards. Anyone who claims a greenhouse gas intensity and they don't have an ISO compliant LC analysis are probably lying or just uneducated. So we are substantially negative carbon, and that's been verified by Minviro, the UK LCA company. And one of the main reasons for that, Matthew, is because we're using a waste gas that is currently being flared and vented, and methane's not very nice for global warming potential. So that's green claim number 1. That's a green fact. That's verified. Secondly, because we dissolve virtually everything and we co-precipitate some byproducts, so the iron ends up as a high purity hematite, a premium grade. The magnesium ends up as a high purity magnesia. We sell them as byproducts, so they don't end up in a tailings residue. And by the way, if those 2 products had 0 value, we'd still be producing them. It's actually inherent in the direct nickel process that they are byproducts. So if they had 0 value, we'd still be producing them. So we end up with a residue that's largely quartz sand, and we've already verified that that is suitable as an engineered landfill, a replacement for quarry sand, so that becomes another minor product. So we end up with zero solids waste. It's absolutely unheard of. I've been in this game 4 decades. To have a project that's negative carbon, zero solids waste, and we have zero process liquid discharge because we recycle everything. So it's absolutely unique. 20 years ago, who cares? Today, particularly selling to North America and EU, that counts a lot, particularly in the EV game, where their only alternative is Chinese, Indonesian, high-pressure acid leach nickel, where you've got about 4 tons of tailings per battery pack in your car.
Right, so which is amazing. And like you kind of almost got a kind of closed loop system, and well, loosely, you got a closed loop system there, which is truly, and I mean, it's I'm surprised that I hadn't picked that up when I sort of read through the material. So do you get to sell the product into the kind of premium nickel market, but do you get, in terms of the cost of money thing, because it's a big deal. One, because it's a lot of money, but two, the cost of money can sometimes, you know, overwhelm a company. So with the Queensland government and perhaps federal government, do you get any other further credits or other further incentives for you because of that?
I think it's not so much a pricing element. Yes, there is an element of pricing improvement on any finance arrangement which we put in place, but it's in terms of the appetite of the debt providers that is the key to funding this.
But what does Queensland government do? Are they underwriting? Would they underwrite the debts? I mean, how involved are they? Because normally it's just like job creation. That's what we want, job creation. But is there more to it?
Oh, yes. I think in terms of the provisions of debt, they will come from the federal government under the North Australian Infrastructure Facility and Export Finance Australia. So they are a federal government funding source. But the state government of Queensland is very supportive of the project. And there's a whole range of areas that they are allowing us to facilitating the approvals. The funding is one area of consideration with a whole host of other, I won't say incentives, but considerations to ensure that the jobs creation, which you highlight, the economic activity in the northern part of Australia, which is a priority and a strategic imperative for the government, both state and federal, can be achieved through the development of this project.
Right. So you come up with quite an interesting novel business idea, and very and the green credibility is it's one of the best I've heard. You've got to deliver this within what kind of time frame are people looking to? Because it's been a short period from now, so like effectively 2.5 years really. When do we see revenue? Because you've got some choices around the funding component. You know how you're going to build this thing out. But ultimately, investors want a kind of growth story, don't they? You know, because if you look at the beginning of end of last year, beginning of this year, there was a kind of drop off in the share price reaction to. Well, why was that? Have you got a sense of why that might have been?
Oh, I think no one has questioned the fundamentals or financial returns of the project. So it's almost unilateral. It's an incredibly strong project from a return and financial perspective. But like all small cap companies developing large projects, the one thing they say is, how are you going to fund it? And I think there was the element of that when the advanced feasibility study came out, and that's still being digested at the moment. And it's up to us to, over the next 3 to 6 months, is to show the path and the runway to funding from both a debt and equity perspective, and give that confidence to our shareholders and new investors that the funding path is available for us.
Right. Okay. And it's not going to be, look, if it's not going to be the debt element that's potentially scares people, given the kind of ecosystem that you said. We've got 100% offtake over here, and kind of, you know, we've managed to kind of reduce the kind of capital component because of the asset that we picked up. It's going to be the equity element. You know, you're whatever, $180 million today, right? You know, it's a meaningful company, but people are going to say, well, okay, how much am I going to be diluted out of this? Do I just wait until that's in place and then I'll maybe come back and have another look at this thing? You'd say to them, what? Why now? Why invest now?
Oh, I think that it's pretty, I think the most important and answer to that question is, you know, the value that is in the stock at these prices reflect a significant risk discount, which will be eliminated or mitigated as we show the funding path through. So by all means, investors that are not shareholders can wait, but the raise that will be at the time of committing to the development of the project is likely to be at significantly higher prices. I think the key to note, Matthew, is that there are a lot of large global funds which we have been in communication for an extended period of time. And it's not only the sustainability credentials Stephen's gone through, but the returns of the project. So there is a significant pool of large institutional investment, which we're continuing our discussions with in order to underpin the equity component of the project.
Right, and obviously, given the studies that you've done and sort of the cost studies that you've done on this one, you in Australia, like us in Europe, have seen energy prices, rocket, especially gas prices. For you, have you? And you're in Queensland, right? So have you looked at any solutions in terms of being able to kind of mitigate some of those, energy price fluctuations, which may affect your margins on this project? I mean, are there kind of conversations going on in the background about how do we do that?
The main we are a very high energy consumer, and that's mostly for process heat, process steam, with a small amount for electricity. That will be generated through the use of natural gas, which is sourced from as a byproduct from the operating metallurgical coal mines in the Bowen Basin. We are formed a wholly owned subsidiary called QPM Energy, which has responsibility for the harvesting, processing and delivery of that gas to Lansdowne Road, which is where the project is. So we are becoming vertically integrated on the energy front. That does two things. One, provides certainty for us in terms of the cost structure of that gas, and secondly, facilitates the development of getting that gas into Townsville within the time frame we needed for the tech project itself. The other thing I'll highlight is that the area where this gas is coming from is currently a stranded resource. It is not connected to the East Coast, particularly to the export market. So the only current mechanism for delivery of that gas is to Townsville, and we would be the largest consumer in Townsville by a significant margin. So those factors significantly reduce the volatility. I would say they would eliminate the volatility in energy prices and allow us to really control what the cost structure will be.
Right, and so the infrastructure to deliver the gas to you is already there. It's just a question of price, not a question of relying on someone else to build infrastructure to feed that into you. It's already there.
There's two elements to it. One is the pipeline from the Bowen Basin into Townsville. That is in existence with the capacity 3 times what we require, and it's currently empty. We do need to build some harvesting and some compressing facilities alongside that pipeline, but that is a very, very modest capital cost, and all the permitting approvals work are well advanced to achieve that within the tech project timeframe.
Right. Just to emphasise that, Matthew, this gas is currently being flared and vented at the moment, several times more than what we need. So it's already happening, and what they lack is a customer. We're the customer, and as Duane said, vertically integrated, we control that destiny.
Another closed loop. Well done. Okay, gentlemen, I think that's really interesting to me. But just give me a sense of what's to come. What are the moments we're looking for this year from you?
I'll start on the semi-technical engineering front. So we're continuing on some test work with our major equipment suppliers. We've got binding agreements with a number of equipment suppliers. We made that decision quite some time ago not to go out and tender. We've chosen the best. So we're still working through the engineering with them, doing some value engineering.
Sorry, we've got essential lights. I'll just keep going.
I'll wait till they're gone. It's energy saving mode.
Energy saving mode. There we go.
I'll wait till Duane comes back in so you have the talking head back in. So we're working with a number of big suppliers. KBR, Jord, Siemens, technical experts for the debt syndicates have started their process already.
Yeah, look, I think, Matthew, 2023 will be a year for us of delivering the financing. So there will be developments clearly on the technical side, which Stephen has been highlighted. We'll have what we think are significant announcements on our energy supply chain over the next 3 to 6 months, probably more 3 rather than 6, which will really eliminate or mitigate the delivery risk of our energy and our energy price, importantly. But over the next several months, we'll have a series of steps which we can convince the investors about the fundability of the project. That will be obviously primarily on the debt and the banks and the agencies we're talking to, and how those indicative interests and the letters of interest we have from them and the quantum. And I think by mid-year or thereabouts, we'll certainly have the capital stack for the project well defined, and investors will see how this project can be funded, and that will move to FID in the second half of this year.
And Matthew, we've I forgot to mention that we actually have 40 million cash in the bank, so we're not out there on the bones of our backside trying to find a way to do this work to get us there.
Right. Well, that was literally the next question, but because I think it's really important, because the process of working with state and federal government, it's an elongated timeline, which is sort of in their control, unless they really want this thing to happen. So there's no kind of, you're not in control of the timing on that one, but you've got the money to be delivering these sort of technical element of the project with the partners that you've selected to advance the project or de-risk the project, for sure. So okay, 40 million bucks puts you in the driving seat there. But look, Stephen, Duane, we'd never met or spoken before with regards to this story, so I do appreciate you coming on. It's a really interesting one. It's a really interesting business model that you chosen, and we kind of will keen to see you delivering the strategy for delivering all the moving parts going forward this year. Appreciate your time today. Thank you.
Thank you, Matthew.
Yes, thank you.